Welcome to Interactive Investors Super 60 Fund Finder.
Those who want to have their money actively managed by a professional investor have two options: funds or investment trusts. Both are a type of pooled or collective investment where lots of investors put their money in and the fund manager decides which companies to invest in on your behalf. This gives investors access to a spread of companies or other investment assets such as bonds or property. But unlike funds, investment trusts are listed on the London Stock Exchange and have a number of structural differences which investors can use to their advantage. With investment trust, there are two layers of activity. There's the performance of the underlying investments that are held in the investment trust, and there's also its share price. If the share price is lower than the value of the underlying investments, then an investment trust is trading on a discount. This offers investors the chance to potentially pick up a bargain. Another of the bells and whistles in the investment trust structure is that trusts can hold back 15% of income generated each year. In turn, this makes investment trusts much more consistent in terms of increasing their dividends or maintaining their dividends compared to open-ended funds. Thirdly, investment trusts can gear or borrow to invest. In a rising market, this can improve performance, but of course, in a falling market, losses can be magnified.
The big question.
You may be concerned about some of your investments on the back of recent media coverage of property fund suspensions and the questions raised about how appropriate open-ended funds are to gain exposure to an illiquid asset such as property. While most funds provide daily dealing with property, some holdings often take much longer to sell. Therefore, fund suspensions can occur to give the fund time to sell to meet investor redemptions. When funds are suspended, investors cannot withdraw their money or invest in the fund. Long-term investors who have a well-diversified portfolio and do not need a short-term capital or regular withdrawals should not panic. But investors who need or want immediate access to their money or for regular investing, investment trusts are the better choice for property as they offer greater liquidity via daily trading. Due to their structure, investment trusts can be fully invested without any concerns over liquidity. Despite the recent challenges, the long-term fundamental case for the property as an asset class remains intact. Yields and valuations still look attractive relative to other asset classes, and property remains a solid option to generate income and as a diversifier to hold alongside shares and bonds. For property exposure, investors could consider BMO Commercial Property and TR Property Trusts. Please visit our website ii.co.uk for more details and other fund ideas.